Now it's time to introduce our esteemed speaker for today's session, Ms. Kavita Agrawal ma'am. Ms. Kavita Agrawal is a chartered market technician and a chartered financial analyst with extensive experience in global equity and commodity markets. She is the founder of EXP Invest, a SEBI registered advisory firm, and has previously worked as an equity research analyst at Avalon Global Research, as an economic advisor at Royal Dutch Shell. We are honored here to have her with us today and now invite Ms. Kavita ma'am to take over the session. Please, ma'am.
Thank you so much, Abhijit, and thank you so much, madam, for your words to all the attendees. So, as Abhijit said, I am a chartered market technician, which is a gold standard in technical analysis. It is a designation, professional designation handed out by the Chartered Market Technician, the Chartered Market Technician Association, or the CMT Association in the US. Additionally, I'm also a chartered financial. So, at this point, I would like to share my screen and take the session forward. So, we are here to talk about chart patterns and how understanding the fundamentals of technical analysis can help you further your motive in the market. Little bit of introduction for myself. I was born and raised in Calcutta, and then I have lived in multiple parts of India pursuing different job opportunities. Then in 2021, right after COVID, I started my own company, EXP Invest. And the purpose of the company was to deliver the outputs of technical analysis as a service to the retail traders. So, as Abhijit said, I have worked as an investment advisor with various organizations, but I felt that the value of technical analysis was not really reaching the people for whom it really matters, nor was I able to unlock its potentials truly in my roles because they were more fundamental analysis inclined. Um, for me personally, I discovered my passion for technical analysis at a very young age. I was in the 12th standard when, with my father's guidance, I started practicing and studying about technicals. I did my CMT during my graduation from St. Xavier's College in Calcutta. And as it turns out, I became the youngest person in the world to clear all three levels of the CMT. I was around 21 when I did that. The next youngest person that I know of happens to be around 24. So, this speaks of my passion for the whole field of technical analysis in itself. Um, in this session, I will take you through the nitty gritties of technical analysis, but with emphasis specifically on chart patterns. To begin with, I want to also demarcate the differentiate between technical analysis and fundamental analysis for those who might be new. Um, Technical analysis is the study of price, volume, time. The whole idea of technical analysis lies in the fact that history repeats itself. Why is that? How does it make sense? Why is it even logical? We are going to discuss that in the next few slides. Why traders use chart patterns and how they impact market psychology, or rather, how chart patterns are formed as a result of collective trader psychology, is also something that we will get into the details of. Technical analysis versus fundamental, right? So, now what is fundamental analysis? Fundamental analysis is looking at companies on the basis of their uh, published numbers, you can say, earnings, their balance sheets, their profit and loss statements. When you get into the details of those numbers, what you're trying to assess is you're trying to find out the intrinsic value of the company, compare that with the price of the company, and then come at a decision. The problem with fundamental analysis is any data that you're looking at is old, is stale. It has a minimum 3 months lag because the earnings come late. This doesn't really make a big of a difference if you're doing a very long term analysis. However, if you want to do a relatively more shorter term decision making, then fundamental analysis may not give you a very accurate decision or accurate output. Moreover, the amount of work that it takes to process fundamental information will limit your coverage to maybe 10, maximum 15 companies, because you have to stay on top of all the news items, you have to stay on top of all the documents that are being published. So it becomes a lot of work. Technical analysis, on the other hand, gives you a lot of coverage, not across in a specific equity sector or a geography, but also across global equity, across different asset classes like currency, commodities, precious metals, even cryptocurrencies now, right? So technical analysis has a far wider application than fundamental analysis does. So for somebody who might be looking for a job as a technical analyst, the availability of the options will be wider, especially now as the world is maturing to the acceptance of relevance for this field of technical analysis. There are disadvantages to technical analysis as well, that it's very easy to get lost in noise. And what is this noise? How to work through this noise? This is also something that we will discuss in this session. All right, so let's begin with the basics of price action and chart reading. We will start with understanding the market structure. The first three most important pillars, like I said, are price, volume, and time. Now, what is price? It is the collective action and expectations of market participants. It is the most critical element because it is only from the price that the indicators and the chart patterns, everything gets derived. But then also remember, what is price? The price is established based on the decisions which have been executed. So anything that is actionable out there in the world with respect to any equity, any currency, any company, it has already been factored it has already been factored, it has already been reflected. You may not see the news related to the information on the basis of which someone somewhere in the world has executed a small or a big trade, but that information has already been factored into the price now that someone has made a execution on the basis of that. You may not see that news on the media or on TV or in magazine yet. So there's always going to be a lag there, but the price is always going to factor all information relevant and actionable about any counter at all times. So chart patterns, trend lines, support resistance zones, they are all derived from the price movement. So price is the final truth, or price discounts every information. This is regardless of opinions related to intrinsic values or fair value of companies. It is only the price ultimately that decides the profit and the loss. When we understand this perception about price, the way we look at it during the practice of technical analysis really changes. Volume. Now, this is the strength behind any move. Price fluctuations are going to happen, especially if it's a liquid counter, non-stop. But whether these fluctuation or the trends that are being formed in price are worth pursuing, are worth catching or participating in, that is something that the volume is going to help you gauge. Volume is basically the number of shares or contracts that have traded in a given period. Now remember, volume is only generated when there is buy and sell at the same time. Volume is never one-sided. It never means more buying or more selling. The volume backing a particular price trend does indicate whether there's more buying pressure or more selling pressure, which basically means who holds the bargaining power. Is it the buyers who are dictating the price at a moment because they have more bargaining power, which might be because of, say, there is some very uh, bad news, so the buyers want to sell, or there's some very good news, so there's a lot of buyers in the market. There's some very bad news because of which the sellers are more desperate, so they're taking whatever price is available in the market. Or there is some very good news because of which the buyers are also desperate, and because of which they are taking whatever price is available in the market, right? So basis those things, the sentiments behind a current counter driving the price action, and the volume, whether there is volume participation behind that thrust in price, that is what is going to help us decide whether a trend is worth participating in or not. So high volume confirms the strength of a price movement. When there are breakouts with high volumes, they're more reliable. Low volume indicates weakness A price move without volume support may be unsustainable. We will talk about failed breakouts towards the end of the session. Let's move on to timing. Timing helps us to gauge the maturity of trends, cycles, patterns. Naturally, trends that are more long lasting are more reliable also, because they don't tend to usually reverse very quickly. They give ample warning before reversing into a correction or into a bearish phase. However, time is the missing dimension in market analysis, because there is no way to predict with certainty what the time frame is going to be. We can obviously always make a guesstimate of that, but for example, in case of price, when you're trying to give a target, we are in a position to give a specific target, and a lot of times these specific targets exactly play out the way we expected them to, right? Even though it's never going to be 100% accurate, but still some level of accuracy can be reached in case of predicting price targets and stop losses. But in case of time, there is no set method of doing so. There are some approaches out there, but they are again not very well proven. So price and volume movements have different meanings on different time frames. So when it comes to time, other than assessing the time horizon for any investment or any trade, we also need to look at the different time frames of analysis, because understand that price is unfolding on different time horizons. For example, you can look at the price activity that has happened in the last 1 hour, the last 1 day, the last 1 week, the last 1 year, and all of them may give you different outputs, may tell different stories, may show different trends. So trends evolve over time. Short-term patterns might be noise in a larger trend. So the Dow theory talks about shorter trends among within larger trends. So in order to understand that and in order to use that properly, the understanding of time frames is very important. Time correction or the sideways movement is just as important as price correction. Now, this time correction is a concept that probably option traders amongst the audience will appreciate, because time correction in case of options trading leads to a lot of value erosion, a lot of premium erosion, as a result of which, even if your stock is moving in your favor, it will result in losses, right? So anyways, time correction also happens in equities. Time correction also happens in cases where there is no leverage involved. It's basically the sideways consolidation in prices. uh, Talking about time, let's also understand the concept of fractals. Now, what is fractals? When a certain pattern is self-repeating, um, basically it's forming fractals. Now, this is very commonly observed in nature in different aspects, like for example, the way shells grow, the way the seeds of a sunflower grow, trees and branches, the way they the way the trees keep branching out into smaller and smaller structures of itself. um, and I have one example over here also. If you can see, each small structure, if you look closely into it, is a representation of the larger structure, or the larger structure is actually formed from smaller similar structures coming together, right? So this is a self-repeating nature, and this is something that is very commonly seen. These fractals are only possible because of this grid that you're seeing. Now, this is the Fibonacci golden ratio, and whatever fractals you will see, they will always have a repeating fraction among them, which is the 1.618, the golden ratio. And this golden ratio plays a very important part in the stock market as well. The concept aligns with Dow theory's principle of trends, the fractals or nature, the fact that smaller trends come together to form larger trends, or that larger trends, when you look into them, you will see shorter trends or shorter patterns getting formed within those. Now, what is the role of supply and demand in shaping price movements? Supply and demand are the driving forces behind all price movements. When demand exceeds supply, price rise naturally. When there is, like I said, if there is a very positive news, there is a lot of demand. Buyers will be willing to take whatever price is available, and that will push the prices up. But when supply outpaces the demand, prices fall. there is some very negative outlook. Everybody wants to sell. Supply increases for a particular stock, a currency pair, or a commodity. Prices will ultimately decline. Support and resistance levels emerge from past supply and demand imbalances as traders react to historical price zones when buying and selling was significant. This also happens because of human psychology, because humans tend to remember prices, and because we have partial memories. Typically, whenever there is a round number, or whenever there is a price at which a past event happened where a lot of buying selling happened, that price tends to stick. And when that price comes back after, say, a major correction, or a major after a major correction, or a major bottom out, then that price again sees a lot of participation. This leads to repetition of you can say either reversals or congestions around certain supply or demand zones, which is also called the supports and resistance. Now, whether it is a support, whether it is a resistance, simply depends on whether it is below the price or above the price. If it is below the price, it becomes support. If it's above the price, it becomes resistance. Breakouts and breakdowns, they occur when supply and demand dynamics shift. So when a price overcomes a resistance, if there is a high demand for it, it will experience a breakout with a high volume, which will be an indication that this is going to continue in the direction of the breakout. This is often triggered by news, earnings, macroeconomic factors. So if there is a new development, we will often see a new breakout of a key resistance zone in a certain um, underlying asset. Volume acts as a confirmation tool, indicating whether a price move is backed by strong demand, that is buyers, or strong supply, that is sellers. So now let's talk about trends. There are three predominant trends in the market. The first being uptrend, which is characterized by formation of higher highs and higher lows. So you can see in this diagram, higher high. So this high is higher than this high. This low is higher than this low. And while this on a very fundamental level sounds extremely basic, trust me, identifying higher highs and higher lows when you're an active trader becomes a very important skill set, because in trading there are so many psychological biases hitting us that we often tend to see what we want to rather than what is. So remembering that an uptrend is identified or defined simply by the formation of higher highs and higher lows will save you a lot of heartache. Again, indicated the uptrend, it is the formation of the higher highs and the higher lows. It indicates strong buying interest and bullish sentiments. Essentially, what is happening? That every time the price dips and it visits the previous high, demand comes back. Why? Because this is where the selling occurred previously, and then there was a breakout. So now this zone where the selling occurred, through which we've broken out, has now become the support zone, as a result of which price comes there and bounces back up. The downtrend forms when the price makes lower highs and lower lows, right opposite. And again, the flip side of the explanation for that, signaling selling pressure and bearish control. Short sellers or cautious investors avoid buying in this phase. A sideways market or range bound market occurs when price oscillates between support and resistance without a clear trend, reflecting market indecision or consolidation. So sometimes, if there is no new news happening, or whatever information is present in a particular account has already been factored in, or there is a major news expected to be broken or published, right? So in that phase, when there is indecision, we will see price often stay stuck in a sideways channel, or a narrow range, or a consolidation, or a rectangle, right? Trends can exist in different time frames, as we already discussed in the discussion of time, and a stock can be in a long-term uptrend but a short-term downtrend. So over here, if you see, this is the overall trend. Overall, the price is going up as identified by the trend line drawn under it. However, within this uptrend, there are downtrends on the shorter time frame, which is also unfolding on the stock. Trend following strategies work best in a trending market, while mean reversion strategies are more effective in sideways conditions. So, this, for instance, is a sideways condition. What is mean reversion strategies? The idea that prices, no matter the trend, will tend to come back to its means. For that, moving averages are used in the market. That's for another discussion. Now, what are the types of charts that are used in technical analysis? The first and the most basic is the line chart. This only plots the closing prices and it appears as a line. This is the most common use for the line chart is usually by long-term investors who want to reduce the noise in their analysis and only want to make unidirectional decisions for their portfolios. Next is the bar charts. In the bar charts, 4 data points are used: the open, high, low, and close. This the image representation is here. Each bar represents one trading period. So you may look at one bar being equal to 1 year, 1 month, 1 week, 1 day, or any other interval that you wish to look at. You can even go for as low as 1 minute or even lower bar formations, right? So candlesticks. Now, next type of chart that is used is the candlesticks chart, and this is also the most common one and visually most rewarding one. Here also the OHLC or the open, high, low, close data points are used, but the body of the color here changes depending on whether the close price was higher or lower than the open price. If the close price was higher than the open, it appears as a white or a green color candle. If the closing price for the period was lower than the opening price for the period, in that case, it may appear as a red or a black colored candle. It has two parts, the body and the wick. The wick is the extremes that indicates how far within the trading period was the high and the low touched. Now, support and resistance. Let's talk about this very important discovery in the market. Support resistance are the critical price levels where buying or selling pressure historically emerged, influencing the future price action. These levels act as barriers that traders watch for entries, exits, and reversals. So, as I showed you here in this chart, the previous resistance has now become the support, and this is where the traders who want to buy the stock will wait for the stock to dip to make their purchase. So strong buying interest comes in at the support. And what is the resistance? It is the price level where selling interest is strong enough to prevent the price from rising further. It acts as a ceiling where the supply outweighs the demand. Now understand the concept of fungibility. Once a resistance gets broken, it turns into support. And uh, when a support gets broken and goes down, when the price tries to come back up, it becomes the resistance. This is the concept of fungibility. Basically, these are supply demand zones. It's better to know them as supply demand zones. And the name support resistance is only derived from whether the price is above the level or below the level. Now, if a stock consistently, so this is an example you can go through if you wish to. Common charts patterns. Now, let's get into the meteor section of this session. We will talk about some of the most common chart patterns and their interpretations. First, we will touch upon some reversal patterns and see how volume also plays a part in that. So the first reversal pattern is the head and shoulder, which can be a bearish reversal pattern. It can also be a bullish reversal pattern. But typically it occurs either at the end of a bull trend or at the end of a bear trend. This pattern consists of 3 peaks. One is the left shoulder, another is the head, and the right shoulder. So here you can see there is a left shoulder, a head, and a right shoulder. In case of an inverted head and shoulder, there is again a left, a head, and a right shoulder. Then there is a neckline. So this line that is joining the shoulders is called the neckline. And it is only when the price breaks through the neckline that the confirmation for the head and shoulder is said to have come. How is the target set for the head and shoulder pattern? The tallest part of the head or the head and shoulder pattern, typically the head will be the tallest part. The maximum distance from the neckline that is projected from the point where the breakout happens, and that then becomes the target for the head and shoulder pattern. The most important aspect when studying a head and shoulder pattern is the volume. So the volume should be increasing during the formation of the head but decreasing on the right shoulder. So basically in this case, in case of the head and shoulder, we will not talk about the inverted head and shoulder because exactly the same theory applies in an inverted manner. So when the head and shoulder is forming, you will see that the volume is strong when the left shoulder forms. It is strong when the right shoulder, when the head forms. But when the right shoulder forms, basically when this rally unfolds, this rally unfolds on low volumes, indicating that the price is now going to, or the thrust behind the upside has reduced, which leads to decline in prices. So the volume profile never flips, it shifts gradually. So the price will stop increasing as aggressively as it was increasing earlier with the volume backing. So volume will gradually decrease most of the times. Obviously, there are exceptions, but the volume participation will gradually decrease on the uprises and gradually increase on the declines until the trend itself entirely flips. So in case of the head and shoulder also, the volume participation is seen to be high on the, when the head is getting formed, that is on the upside, but when the right shoulder gets formed, the volume typically declines. And then when the neckline is broken is when the volume again increases and the price decline continues. Next, let's talk about the double top and the double bottom. Now, this is a very strong reversal pattern. The double top is obviously a bearish reversal because it's forming at the top of a uptrend. Excuse me. All right, so the double top and the double bottom. The double top forms when the price tests resistance twice but fails to break higher. It indicates a strong selling pressure and signals a potential downtrend. Confirmation happens when the price breaks below the support neckline. So what is happening here from a supply demand perspective? Price increases with volumes, declines, takes support, goes again. But now this resistance here fails to break. Why? Because buying pressure has declined or the selling pressure has increased. As a result of that, a double top has formed. When the dip in between these two peaks, when this dip gets the level of this dip gets broken, that is when the double top formation is said to be confirmed. The problem with the double top formation is that by the time you get the confirmation by way of breakage of this line, a lot of the movement will already have gone. Now we don't know whether the price is going to retrace the entire uptrend or it is just going to take a dip. But again, there is no set way of setting up the target. It says the distance from the peak to the neckline projected downward, but this may not be enough of a target to make it worthy of participation. Double bottom is exactly the opposite of the double top. Price tests a support level twice and holds, indicates a strong buying pressure and signals an uptrend. Typically, double top and double bottoms work best on larger time frames, but they also do well on smaller time frames like 75-minute or daily time frame. Next is the rounding bottom and the cup and handle. So the rounding bottom is again observed best on the larger time frame charts, and this indicates a gradual reversal in prices, gradual shifting in the sentiments towards a particular broad market index or towards a particular stock. It can be anything. It's a gradual U-shaped bottom showing accumulation and slow reversal from a downtrend. Buyers slowly regain control over time, leading to a breakout above resistance. Takes longer to form compared to other patterns. So this rounding bottom is one of the uh, longest unfolding patterns. So here, basically, from a psychological or demand supply perspective, what is happening is that the decline was sharp. Then there was some consolidation in the price. Why? The often within a rounding bottom, you may also see a double bottom formation. You may see a rectangle formation, right? And then resistance, a breakout happens. So when is the rounding bottom set to be confirmed? When the resistance zone of the base formation has been crossed. That is when we say the rounding bottom is completely formed, and it is the trend has reversed. Next is the cup and handle. So cup and handle takes the rounding bottom and adds another observation to it. So the cup is the rounding bottom followed by a small handle, that is a slight pullback. Now what is this pullback in the market? Basically, this happens because the people who, or the buyers, the early buyers within the trend, they seek an opportunity to now book profits, and they typically do that closer to a resistance zone. So when a resistance is reached, the price experiences a slight dip. During this dip, if there is more positive news left, or if there's more upside left, then the buyers who had missed the first part of the trade, they will jump right back in, leading to another leg of rally and a breakout. So this dip and subsequent rally is what forms the handle of the formation, and this is said to be confirmed when the highest price established after the reversal is again breached. So basically, you are looking at a very simple concept of a breakout here. So let's talk about some of the key takeaways. Volume confirmation is key. So anywhere where I have said breakout, everywhere the volume confirmation will be the key, because the stock market throws a lot of curveballs. Any equity, any markets, any listed market throws a lot of, uh, any public market throws a lot of curveballs, and confirmation backed by volume will be very important to avoid those bull or bear traps. Enter only after the price moves beyond the key levels. Use stop loss to manage risk. Every pattern has invalidation points. So the patterns that we've discussed so far, we've only discussed about the confirmation bit. But suppose you're seeing a cup and handle formation, cup and handle pattern form, but the price reaches this level of confirmation but doesn't go back up. Instead, it goes down and breaks below this low. That will mean that the cup and handle formation has been violated or invalidated. So every pattern will have an invalidation point like that. The bigger pattern, the bigger the pattern, the stronger the move. Naturally, if it's a bigger pattern, typically it will occur on a larger time frame, or even within a shorter time frame. If it's taking a lot of time to form and the breakout is happening with strong volumes, it will lead to a pretty strong move. When it comes to chart patterns, it is good to know the names and the nomenclatures and the nitty-gritties when you're starting out. But for someone like me who's been in the market for more than a decade now, um, for me, the name of the chart patterns and the details, the smaller details, are no longer relevant. What really matters is the supply demand, is the actual market structure or the activity that is happening behind, which is leading to the formation of those patterns. So this simplifies the practice considerably. It reduces the debate of whether it is logical or not, of whether it is correct or not, because now we are looking at things from a logical perspective rather than textbook perspective. So what truly matters is the underlying supply and demand dynamics that creates these formations. So once we start understanding the supply and the demand, the support and the resistance, the volume, the role of volume in the formation of these patterns, things make a lot more sense. All right, next, let's talk about continuation pattern. So continuation patterns indicate that the existing trend is likely to resume after a brief consolidation or pause. Now remember, reversal patterns happen when uh, a certain price trend has unfolded and now it is exhausted, reversed, and it goes the other way. But appearance of a pattern is not always necessarily indicative of a reversal. Sometimes the price trend just needs to take a breather. That is when a continuation pattern occurs. So if the price is not trending in its previous direction anymore, doesn't necessarily mean that it is going to completely stop and reverse. It might just be taking a bit of a rest. It might come back and resume its trend. So let's look at some of these patterns which indicate exactly that. So the first pattern is the flag pattern. Very common pattern, very effective pattern. How is this formed? When a sharp price rally occurs, after that a resistance price typically gets reached. Now this sharp rally, which establishes the pole of the flag, is followed by a mild correction. Now this downward sloping rectangle shaped correction needs to be accompanied with low volume, indicating that while there was high buying pressure, eager buyers, there is not many people who are willing to sell. So low selling volume. Then this rectangle pattern's upper or resistance line gets breached, which again establishes the next uptrend. So typically the target for the flag pattern is set by projecting the breadth of the flag from the point of the breakout upward. Next is the pennant or the short-term consolidation. So the pennant pattern is very similar to the flag pattern. It also occurs after an uptrend. But in case of a pennant, the uptrend may not need to be as sharp as in the case of the flag pattern. Even if it's a softer or a more slopier uptrend, the pennant basically looks like a small downward facing triangle. Pennant and flag patterns are typically observed on the shorter period time frames and are more effective, I would say, on the shorter period time frames. So the pennant also forms after a sharp price movement, but in small symmetrical triangles instead of parallel channels. Unlike a flag, which slopes slightly against the trend, a pennant shows a narrowing price range before a breakout. So in case of a pennant, the price may not, the entire pennant may not be sloping downward. It may be sideways, showing that the price is not going up, but it's also not declining. So price is just kind of forming into a coil kind of a formation, and then it breaks out from the resistance line and continues into the uptrend. The wedge pattern, it is a potential reversal or continuation. So the wedge pattern can be either. A wedge pattern is a sloping converging price structure where price moves within two narrow trend lines. Unlike flags and pennants, which form after sharp moves, wedges take longer to develop and can signal either a continuation or a reversal. Now let's talk about triangles. There's a lot of confusion when it comes to triangles because, again, like I said, the names can be confusing, and focusing a lot on the nomenclature can be a little distracting. So let's get into the understanding of triangles, how they are formed, and how to identify what they are going to do or how to predict reliably what they are going to do next. Triangles indicate a gradual tightening of price movement where supply and demand converge before a breakout. the ascending triangle or the bullish continuation. Price forms higher lows. So in this case, this is a ascending triangle. You can see the price is forming higher and higher lows. This is indicating the buildup of buying pressure. There is a flat resistance line which is showing consistent selling pressure, but the support level or the lower trend line keeps increasing, showing that the buying pressure is now coming in faster and faster and faster and faster, right? Until there is a breakout through the, so basically the buyers tend to or end up overpowering the sellers. Resistance remains flat at the top, showing a ceiling where sellers are active. A breakout above resistance leads to continuation of the uptrend. Naturally, this breakout has to happen at high volumes. It needs to be backed by high volumes to be relevant. The target of the ascending triangle is again set by taking the broadest part of the triangle and projecting it from the point of the breakout. Now, if you flip this, it becomes a descending triangle in which the price forms lower highs with a consistent lower trend line. So the highs that are formed within this descending triangle tend to get lower and lower and lower. And this indicates the increase in selling pressure. Support remains flat at the bottom where buyers are attempting to hold the price. So there are buyers which are coming in consistently at this level, but maybe anxiety around this particular counter may be increasing, because of which what is happening, every time the price takes a bounce back, every time the price is going back up, whoever is holding it is ending up selling it faster and faster and faster and faster, because of which there is a series of lower highs getting formed. Now, at some point, the anxiety of the sellers is going to exceed the anticipation or the confidence of the buyers, leading to higher selling pressure, leading to breakout, which, if backed by strong volumes, will mean continuation of the trend towards the lower side. Next is the symmetrical triangle. So like the wedge, again, the symmetrical triangle can lead to a reversal, can lead to a continuation. So in this case, the price forms lower highs and higher lows, creating a tight consolidation. So because both the sellers and the buyers are active, and because the support and the resistance at the same time are converging, it is very difficult to predict in which direction the breakout is going to come. Another very interesting fact about the symmetrical triangle is that they often also lead to bull bear traps. What does that mean? It may break out in one direction, but it may pull back, reverse, and break out in the other direction in the next few days. So if you're not managing your risk when trading a symmetrical triangle, the risk of loss can be significant. Again, if it is giving a breakout from the downside, it can reverse and give a upside breakout as well. So if you're selling your holdings prematurely, if you're taking a short position there without, again, being vigilant about how the pattern follows through, there can be significant loss or potential loss. So how to use the breakouts effectively? Wait for confirmation. Traders often enter trades too eagerly without waiting for a strong close, especially beyond the triangle boundaries, using higher volumes, and it's always better to use higher volumes as a confirmation tool. When you enter with a proper stop loss. Firstly, buy above the breakout levels, not in anticipation of the breakout levels. When it comes to ascending triangles or symmetrical triangles, short below the breakdown levels in descending triangles. Stop loss should be set below the last swing low when it is bullish and above the last swing high in case of bearish. Target projections, like I said, measure the widest part of the triangle and project it in the breakout direction. Next, let's talk about rectangles. So we already touched upon rectangles very briefly when we talked about the cup and handle or the rounding bottoms. Rectangles and consolidation ranges, identifying accumulation versus distribution. Rectangles form when the prices move sideways between two parallel lines. Horizontal support and resistance. Now, just parallel lines is not enough. It has to be a horizontal support and resistance, because we can draw parallel lines on an upward or a downward trend also. So if it's a horizontal support and resistance lines that you've drawn and the price is moving in between that, then you have a rectangle or formation or a consolidation zone or a choppy market. This can either be the accumulation, that is the bullish continuation, or distribution, that is the bearish continuation. The key is how price breaks out of the range. Now, how to differentiate between consolidation and distribution? Now, accumulation or bullish continuation, it happens after a strong uptrend. Price holds above key levels and does not make lower lows, and breakout above resistance leads to further uptrend continuation. Uh, Accumulation can also happen at the end of a downtrend, uh, but again, it has to be in a rectangle formation. Now, how do you know that accumulation is happening? Within the rectangle formation itself, you will be able to see that when the price travels from the support to the resistance, it experiences higher volumes versus when the price travels from the resistance to the support trend line. So this itself is an indication of accumulation. I prefer to typically use volumes on a histogram to assess this or to observe this in a more obvious manner. Accumulation can also happen within an uptrend itself. So after a strong move, the price can stop for some breather. Within that phase of sideways consolidation, you may be able to observe that the volume increases on the price rises versus the price declines. And that also indicates to you that more accumulation is happening, which in turn indicates that more upside can be followed after the end of this rectangle pattern or this accumulation phase. Breakout above the resistance leads to further uptrend continuation. Now, the distribution is right opposite to that. It is the bearish continuation, or it can, like I said, also be a reversal. It happens after a strong rally but with declining momentum. It can also happen at the end of a strong uptrend where buyers have been exhausted and sellers start to gain strength. So at the end of a uptrend, if you're seeing a rectangle pattern, within that rectangle pattern, further analysis can be done by going one time frame lower and assessing the trend versus the volume patterns. If the volume is increasing on the downside versus on the upside, or if it's increasing more on the downside than on the upside, it will indicate that the selling pressure is higher. The sellers are coming in control. There is a gradual shift that is happening. Price struggles to break higher and starts to form lower highs. Breakdown below the support leads to further downside continuation. Often when you see the rectangle pattern is formed, the candlesticks that will be observed, you will notice the wicks exceeding beyond the support levels when there is heavier distribution happening. When there is heavier accumulation, you will see the wicks or the shadows forming spikes above the resistance zones, indicating accumulation or increase in buying pressure in the stock. So continuation patterns help traders ride existing trends with confidence. It also gives a good entry zone, because sometimes when you try to catch a trend that is unfolding in a very hot manner, it the best analogy that I like to use for it is trying to catch a running train. We have to understand that these support resistance zones act as important bus stops or train stops. Instead of injuring yourself chasing that, it's better to wait for the train to stop at the next best stop available and then board it. So wait for the price to come back to its support or break above a key resistance level before you make a participation. Without assessing the price support resistance, without giving due consideration to the strength, the volume of the trend, you may find yourself participating in stocks or any other underlying right at the top, right before a major reversal hits. So it's important to do that analysis before you hit the enter key on your keyboard. So look at the volumes for confirmed breakouts, because even if the support and resistance levels are being enacted but the volume is absent, it may again not play out in your favor the way you want it to. Setting proper stop losses and targets ensures risk management. Now, when it comes to the concept of setting stop loss and targets, you have to always pay attention to the concept of risk reward ratio as well. What is risk reward ratio? It's a ratio of your target percentage to your stop loss percentage on an absolute term. So if you are looking at a target of 15%, but your stop loss based on the closest support level has to be 10, in this case your risk reward ratio is 15 by 10, which is 3 by 2, which is 1.5, may not be enough to justify participation. Versus if your target based on support resistance or chart pattern analysis comes out to be 15%, but your risk or stop loss comes out to be only 5%. In this case, your risk to reward is 15% divided by 5%, which is 3. This is enough for you to go ahead and take a risk on your capital. So in the stock market, based on chart pattern analysis, you will see that there will not be a dearth of opportunities, but you have limited capital. So in order to justify or in order to optimize, it is important to be very picky. It is important to be very choosy when it comes to allocating your capital, and risk reward ratio can be a good metric to help you identify the better trade setups to participate in. Triangular consolidations can break in either directions. Always wait for confirmation. So we talked about the wedge, we talked about the symmetrical triangles. They can move in either directions. It's very important to wait for confirmations, but again, have stop losses in place when you take any positions, because there can always be bull traps and bear traps. There is always a risk of failed breakouts. Strong breakouts lead to impulse moves. Typically, when a breakout happens with strong volume participation, there is a good chance that it will not lead to a failed breakout. That is why we always want to look at the volume and seek more confirmation before we take the trades. Understanding the essence of chart patterns. So this I have already discussed when we concluded the reversal patterns. Now let's look at some of the practical charts and then how to build a trading plan. But before that, let's look at some common mistakes that traders make with chart patterns. For example, false breakouts and how to avoid them, over trading and risk management. Now, there is a whole field of behavioral finance, which in itself is a whole subject, right? Which talks about or deals with the common repeating human weaknesses that get reflected in trading as well. So, like I said in the beginning, stock market price formation is a reflection of the collective psychology of all its participants. All the chart patterns that we are seeing, formations, this is also getting formed because the participants collectively are reacting to something. They are behaving in a manner that is consistent with something, or there is a commonality because of which these patterns are getting formed on the charts. As such, there are biases that need to be dealt with. There are repeating mistakes that need to be avoided. And this needs to be done consciously, because everybody who comes to the stock market or who starts trading using technical analysis or any other methodology, may it be quant, may it be fundamentals, there are always going to be biases which kick in. There are going to be mistakes which can be repeated because of these biases. So, common mistakes traders make with chart patterns. Chart patterns can be a powerful tool, but misinterpreting them or using them without proper risk management can lead to losses. Below are some common mistakes. False breakouts. How to avoid them? A false breakout occurs when price moves beyond a support resistance level but fails to sustain the breakout and quickly reverses. It often traps traders who enter too eagerly, leading to stop loss hits before the real move happens. False breakouts manipulate retail traders into taking bad positions while institutional traders accumulate liquidity. Now, false breakout is not a mistake. False breakout is a reality. What is a common mistake that a trader can make when trading with chart patterns? It is not using stop loss. If you don't use a stop loss, if you don't exit the trade when the chart pattern has been invalidated, when the reversal or the breakout has been invalidated, you will end up holding on to that stock and incurring more loss than you can either bear or than your portfolio justifies. How to avoid a false breakout? So there are disciplines, there are things that you can do to firstly avoid the false breakout, but there is also setting the stop loss, which can help you reduce your loss or your exposure by helping you get out of the trade. So to avoid the false breakout, there are 4 things that you need to do. Wait for confirmation. A strong close above resistance or below support. Check volume. Low volume breakouts are unreliable. Use multi-time frame analysis. Align trades with the bigger trends, but look at the smaller trends to identify more patterns and to gather more evidences to support your investment case. Retest your strategies. A successful retest strengthens the breakout signals. If you are interested, say, in trading the flag pattern, the pennant pattern, the head and shoulder patterns, it will be worth your time to go back into the price action history and assess whether a particular counter that you are interested in trading has a tendency to form those patterns repeatedly. Like I said, chart patterns are the result of collective psychology of its participants, and because we as participants tend to stay or stick with a certain set of counters, a certain set of equities, the result of these collective participants collectively taking decisions leads to the formation of certain patterns more commonly on some counters versus others. So for example, Nifty may form the wedge pattern very often. Gold may form the head and shoulder pattern very often. Some stocks, say Reliance, may form the double top or the double bottom very often. Some stocks, say Asian Paints, may form the rectangle pattern very often. So stocks, underlying assets have their own tendencies to repeat certain patterns because of the collective psychology of the participants who keep coming back to trade in the stock. Now, just like with a person, you know that they have certain tendencies. For example, if there is a big exam coming, some people have the tendency of stressing a lot about it, but at the same time they prepare very hard and then they excel at the exam. Some people don't stress about the exam at all, they prepare and they excel at the exam. Some people have a tendency of stressing a lot, but they also don't prepare and they don't do so well. And then there are some people who don't stress at all, who don't prepare, and they also don't do well at the exam, right? So just how different people can have different responses to different to the same scenario unfolding, and their results depends on it. Similarly, in the stocks or in the chart pattern analysis and trading also, the participants can react in certain ways, which can look like a certain behavior on the chart, a certain stressor on the chart, and then certain outcome that can lead to a certain outcome, right? So always focus on doing past trade analysis. Identify the most common patterns which an underlying is more susceptible to form, and see how often are these breakouts happening. What is the volume um, pattern looking like? What is the time duration of the formation of the patterns? Look at all these various parameters, make your notes, and then continue to stick with those patterns or those counters over time. Next is overtrading and risk management, rather the lack of risk management. Overtrading happens when traders take too many trades without solid setup. It is often driven by emotional trading. I made a loss of 2000 rupees yesterday. Today I have to make it back. Or the market is very volatile, or I am feeling very stressed, so I'm going to keep buying and selling. Fear of missing out. The budget has been great, so I need to buy the stocks, say Avanti Feed, because the finance minister has spoken about shrimps. That's a fear of missing out. Addiction to market activity leading to excessive screen time. If you're constantly looking at screen, you will constantly make up patterns which are not there in your mind, and you will end up executing trades with real money and making real losses. So reduce your screen time. Don't let burnout get to you, which is very easy when it comes to assessing charts and becoming a technical trader. So you need to have those fail stops in place. How much screen is too much screen time for you? How much trading is too much trading for you? How much of your capital do you want to expose to market risk? When do you say enough is enough? When do you take a step back to reassess the situation and come back with a renewed game plan? So these introspective aspects are often lacking in majority of traders, which is why more than 95% people who come to the market are in net loss. Barely, like after those 95% people experiencing net loss, barely 2 or 3% people are able to break even. That leaves 1, 2, or maybe at most 3% people who are able to generate returns. Even among that number, only 1% of the participants are able to generate return, which is more than uh, the benchmark returns of a standard index where you can simply do index fund investing, right? So naturally, since trading or investing is so competitive, it's so rewarding, but it is so competitive, it takes exceptional amount of skill set, it takes exceptional amount of planning, and it takes exceptional amount of self control. So over trading increases your transaction cost, obviously, because you have to spend more on brokerage, more on security transaction tax, more on stamp duty, all of those things. It increases your exposure without an edge. So if you're trading too much, naturally you are either not adhering to your setup, or you're trying to work with too many strategies at the same time, as a result of which you don't have an edge in any of the strategies. So when it comes to the stock market, when it comes to technical analysis, it's better to work with one, maybe two strategy at a time. Forget about everything else. And again, there will be times when your strategies don't work. For example, if you are a momentum trader like me, then a downward trending market or a sideways market means a time when you need to sit back and relax, look at the market, do your analysis, but stop trading. Because until and unless a fruitful trade setup doesn't come up, the execution keys should not be hit, and strong risk management also has to be maintained. For example, now that the market has been bearish since the past 5 months or so, I have been taking trades, but only where the risk reward ratio is minimum 3 and with strict stop loss. So I never have an active trade which doesn't have an active stop loss order, which is being trailed. So I also look out for the resistance level. As soon as it is breached, I tend to trail my stop loss to again reduce my loss or exposure in the market should the prices reverse and continue to decline. How to avoid overtrading? Stick to high profitability, high probability setups. Now, how do you know whether a particular setup is a high probability setup or a low probability setup? It's always good to build an investment case with multiple evidences and no red flags. To elaborate on that a little bit, look at multiple time frames. If your decision is being made on the basis of analysis of the daily time frame, also look at one time frame lower, which for you may be hourly chart. For me, it's the 75-minute time frame. Also look at the higher time frame to make sure that your decision or your analysis adheres to the broader trend that is unfolding, but at the same time the smaller trends are also in your favor. The volume profile can be more minutely observed in the lower time frames. So stick to high probability setup, look at chart patterns, look at volumes, look at support resistance zones, look at trend lines, and then make your decision. If doubt exists, skip the trade. If there are any red flags, skip the trade, look for something which is more convincing. Follow a strict trading plan. Set a daily trade limit. I will take 2-3 high quality trades per day. Don't go for taking 8, 9, 10 trades, because you look at them, you feel the fear of missing out, and you're like, I need to execute this trade first. I can make my notes later, or I can tick off my checklist later. When you get to ticking off your checklist, you realize that this was not as high a quality opportunity as you originally thought, and you made a hasty decision leading to real financial loss. So follow a strict trading plan, have a checklist. Look at the checklist. It's okay if the stock moves away from you. There's always going to be more opportunity coming your way. Define your entry, stop loss, and target levels before entering the trade, and make sure that the risk reward ratio is such that it is worthy of your capital. For me, that number is 3. Use the 1-2% risk rule. I am personally not a big fan of the 1-2% risk rule. Uh, I do use this on an overall portfolio value. Like for instance, I never want to lose more than 2% of my entire portfolio value in a particular month. So if I'm reaching that number, it basically means that the market is not in my favor, and maybe I have some biases activated right now, which is not allowing me to see that. So this will become a fail stop for me, and I will stop trading immediately. I will go back and look at my past trades done in the month or in the quarter gone by, and I'll try to assess what has been um, hindering my objectivity, which has compelled me to take these trades, or what in my trading system has been lacking, which has led me into these trade setups, which led into consistent losses over the last few months. Because there might be something about the current market dynamics which doesn't work with my trade setup. I need to understand that, I need to identify that, and it can only happen on the basis of past trade analysis or introspection. Now let's look at some charts, real charts, and identify patterns and how they worked. Now understand that when it comes to chart patterns and trading those chart patterns, they don't occur in isolation. As the price unfolds at different stages, different price patterns are unfolding. So that is also why transitioning from theory to practical and technical analysis can be a little overwhelming, because what you were seeing in silos in the book, in the text, is now all coming down at once. You're looking at the price, you're looking at the volume, you're looking at indicators, you're looking at chart patterns, and they're continuously unfolding on you, and they are unfolding on different layers and different time frames. So it becomes overwhelming, and it becomes very uh, easy to kind of do an incomplete work by way of looking at only one time frame, by only looking at one trend unfolding, by only looking at one um, parameter and making your decision. But that will not give you a holistic picture. So what you need to do to get a holistic picture and make better decisions, you need to look at your indicators, you need to look at chart patterns, you need to look at different time frames. But again, there is a risk of doing too much. If you're looking at too many indicators, if you're looking at too many chart patterns, if you're looking at too many time frames, you're also getting distracted, you're also getting burnt out. So you need to strike a balance. You need to define first what works for you, what is doable for you, realistic for you, and then you need to work with that. Now here we have a USD Canadian dollar, a currency pair chart, and here you can see the formation of small flag patterns during the early uptrend. So after a downtrend, the price has started to reverse here. Here we see the flag patterns form. Now flag pattern also typically has a tendency to form towards the starting of the trend, because that is where the thrust for the upside is the maximum. So two flag patterns were observed here, and then a wedge pattern formed, which ended up with a upward breakout. Now, immediately after the breakout, there was a rectangle formation here, which again led to further upside, and then again a range with a small positive angle. You can call this a upward sloping triangle. This upward sloping triangle also gives a trading opportunity where you can buy near the support and sell near the resistances. And then upward breakout again. On after the breakout, as the price unfolds, small consolidations were noted here, and then distribution is finally noticed upward in a horizontal rectangular pattern. Taking another example of General Electric, which is a stock listed on NYSE. As the uptrend started to unfold, a bullish rectangle was noticed. Now the target is this yellow arrow, which when projected from the level of the breakout. Now on the breakout, you can see that there is some, so breakouts can again sometimes be very sharp or they can be very mellow. So this is a mellow example of a breakout where the price has gone above the resistance, but it's not immediately ascending higher. It has gone into some consolidation. So your stop loss will be it can be either the midway of the bullish rectangle or on the other side of the bullish rectangle, right? So the minimum target over here you can see got reached. As soon as the minimum target was reached, price experienced resistance and fell back to the support. What was the support? The previous resistance has acted as the support in this case, right? Now here onwards the rally again started, and as the price continued to go up, it started making higher highs and higher bottom formation. After a significant portion of the rally, it was time to take a breather. That is when the price formed an expanding triangle. Now, we did not discuss the expanding triangle, but expanding triangle is formed when the resistance tend to be formed higher and higher, and the price also forms lower lows, right? So this is typically a continuation pattern. Again, we see the previous key lows were not broken and higher low continues to be formed on the price. Now let's look at accumulation. So here we also have volume. After a prior downtrend, the price gets stuck in a sideways rectangle. This is also a rounding bottom formation, or a cup and handle formation can also be noticed in this. If you look at the volume, up to this point, the volume has been picking up repeatedly. This indicated to us up to this point that the decline was backed by strong volumes. It was not a good time to make fresh entries. But then what happened? As we entered the consolidation, the volume activity decreased. And after the second half of the consolidation, the volume activity has started to increase on the price upsides, indicating that buying pressure seems to be coming back on the stock. Once there is a breakout, now this breakout you will notice has happened against very, very strong volumes. This was an indication that this breakout is a better quality breakout. Then the target could be extended by taking the breadth of this rectangle and projecting it from the breakout point. That target was achieved, basically also laying down the resistance. The price fell back to the support level, which is also called a pullback, and then bounced back up. Right, again, when the price started to go up, you can see the volume again started to pick up a little bit, right? So this high and this dip and this up, this is the handle formation, this is the cup formation. So you can see lot of the chart patterns are actually overlapping in nature and they unfold at the same time. So with that, I come to the end of my discussion. I hope I was able to keep the time. But let's talk about some of the key takeaways for the session. All right, chart patterns reflect the supply and demand dynamics, not just the shapes. It's important to focus on the volume and the key price action for confirmation. Pattern recognition enhances trading accuracy, but the context matters. Always analyze the trends and multi-time frame alignment. So like I said, make sure that the chart pattern, whatever it is indicating to you, aligns with what one higher time frame trend is also indicating. So when you reach that alignment between different time frames and different patterns and observations, you get a better, stronger, higher probability trade setup to execute. False breakouts are pretty common. Wait for confirmation, retest, and volume validation before entering. Less is more. Successful traders focus on high probability setups instead of over trading. Patterns are powerful tools, but their effectiveness depends on discipline, patience, and risk control. Charts do not predict the future, but they tell you where the markets have been and where the pressures lie. So I will again emphasize that the context matters. Never trade a pattern in isolation. You see a flag pattern doesn't mean that you go ahead and take a position there, because if the higher time frame is bearish and the lower time frame for whatever reason has formed the flag pattern, there is a good chance that it is going to give you a false breakout leading to a bad bull trap and then reverse. So you need to look at multi-time frame analysis to assign strength or to assess the probability of success for different chart patterns. Market conditions, macroeconomic trends or updates, strength of the trend unfolding in the sector, in the stock, the volume, all of these play a very important role in confirming chart patterns. Indicators, momentum indicators like relative strength index or volume indicators, when or volume being used as MACD, all of those things can help you assess the probability of your trades better. Multi-time frame analysis is key. A bullish flag on 5-minute chart may be meaningless if the daily trend is down. Liquidity and news influence patterns. Breakouts can fail due to macroeconomic events or low volumes. Combine with indicators. Use RSI, volume trends, moving averages to confirm pattern strengths. Historical support and resistance can override a pattern. Example, a head and shoulder breakdown failing because of strong long-term support. Context is more important than patterns. Always align your trades with broader market conditions to maximize your success. This is a list of few books if you're interested in technical analysis, if you want to strengthen your understanding of price volume correlation. You can look at some of these books. I have studied all of these books and obviously many more in the field of technical analysis, and each book has a lot of insights. So when you do read these books, I will suggest don't pick it up as a light read, because technical analysis is something that will require you to study and observe what you've studied practically to actually help it sink. So I always like to say that technical analysis is a combination of art and science. It is science when you begin with, because there are certain principles, there are certain theories that you need to memorize. But once you've done that, once you've understood that, it becomes an art. The more you practice, the better you get at it. There are some online resources like Investopedia, the Training View for charting, obviously, and the blogs on my website, where I share a lot of insights about technical analysis and the practical applications of technical analysis. So you can visit my website for the blogs. Now let's begin with some Q&A. If you have questions about me, feel free to ask. You can ask me about, I have some prompts on the screen for you. So I will let you ask questions if anybody has them.
Good evening, ma'am. This is Dr. Uma from Bhavans College,
Hello, Dr.
Secunderabad.
Rama.
I'm not a trader basically, but I do invest in stock market. But now the scenario seems to be very scary. What is your opinion about it? Like, according to your analysis, what's going to happen? What have you predicted?
Okay, so when you say scary, I hear you have an emotional response to what is happening. But
Okay.
if you look at the market history, you will realize that this is nothing to be scared of, because this is nothing out of the ordinary. Right now, all that is happening in the market is a correction. This is not even a crash, as a lot of headlines like to call it. The
Yeah,
market
that
has
is what
been,
is more worrisome, ma'am, actually. The media, the information, because we are not good at technical analysis. Basically, I joined this to learn what it is. Like I'm not able to read the market. So
right.
you're so good. So I wanted to take your opinion.
Absolutely. I strongly believe that where, from a macroeconomic perspective, where the country stands right now is an inflection point. We've seen strong rally unfold on the chart of Nifty post COVID in the broad Indian market, in the broad Indian market context. Strong rally has unfolded, but that has not really seen a breather, a correction. When I look at the broader time frame charts like the weekly chart, what I see is that this underlying bull trend is still intact. Nothing has broken. This is a mere correction, and it has not even reached its support levels on the broader charts. So yes, while this feels like a very long correction, and the role of the media is not to help you make money. The role of the media is to help themselves make money. And when do they make money? When you keep coming back to read their headlines. And when is that going to happen? When you feel a strong emotion. And there is no emotion stronger than fear or greed. So when the markets are going higher, the media is going to tell you it's going to go higher and higher to fuel your greed. When it's falling, it's going to fuel your fear by saying it has never been so low in the past 5 months, in the past 1 year, in the past 10 years. 10 years is obviously scary, but you know what I mean. So right now,
Yes.
I think from a fundamental or macroeconomic perspective, India is in a very strong position, and the budget that we saw was a very strong budget. The government is cognitive of the fact that the manufacturing sector is slowing down. So rate cuts are going to be a common phenomena now, since inflation is also under control. And I think now is a very good time to stay committed in the market. And it is so heartbreaking to see that for retail investors, because of fear mongering by media, this is the time when they want to stay the furthest from the stock market. But I think from a long term perspective, which is what you're interested in, Dr. Roma, the broad market looks very bullish. That's my personal
Thank
opinion.
you, ma'am. Is it the right time to buy the stocks then now?
Yes, for
What is your
sure. You should do
suggestion?
it in a SIP format where you make allocations to the market every week. Identify a portfolio of either 6 to 10 stocks, or not more than 15 stocks, and start buying them in small quantities. Metals and auto sector are two sectors that you should really look at, even banking.
Pardon, ma'am, what are the sectors?
Banking, metal, and auto sectors. For a
Okay,
retail investor, to be honest, doing stock specific investment can be very risky. So, good approach would be to invest in sectoral ETFs or broad market ETF.
thank you so much, ma'am.
Of
It
course.
was a very, very excellent session.
Thank you, Dr. Omar. Anybody else would like to ask a question?